What if I told you becoming a profitable trader is actually way easier than you think? And I myself used to be unprofitable until I made a few small changes that completely transformed my results, making me over 400K in the first year of implementing them. And in this video, I'll show you exactly what I did and how you can do the same. You can see here I made $56,000 in 1 week. I became a Top Step certified live trader. And once you start to understand everything, it just becomes rinse and repeat. And so why don't we start off with something simple? Like, what is trading? I think the most reason traders fail to become profitable is because they rush into things. They rush into them too quick. They think that they'll become millionaires overnight. But the best piece of advice I have for you is to take it slow and understand why and what you're doing before you just start throwing money at it. So starting with the basics, what is trading? Trading is the act of buying and selling financial assets, whether it's currencies, stocks, or crypto. And you make profit when price moves in your favor, as in when you're buying and the market goes up, you make money. The market goes down and you're selling, you make money. And all of that works as long as you're protecting your money first. And so what I mean by that is to have that good risk management. You have an account, let's say it's $5,000. You don't want to blow all of that on one position. You take your small wins, your base hits, and let your account compound. And before you know it, as long as you're following a good system and you're consistent, eventually your account will compound and grow into an account that you actually enjoy seeing, rather than trying to, all right, let's flip our 5K account on one position, and you might hit on that position. You might make your 10K, but then you're going to keep doing it. And then eventually you'll blow it up and lose everything. And so how can people win at trading? That is starting with minimizing your losses. Like, you have to accept your loss. Eventually the market will hit an area on where you don't want to see price going. And at that point, your idea is wrong and you need to accept that loss. And you don't want that loss to essentially put you in a position that makes it hard to trade. Like if you don't have enough capital to take a position, it really makes it difficult to continue trading. Like, as long as you can minimize your losses, you can keep swinging. You can keep learning on what you're doing, and really just to take it slow, letting those setups come to you, waiting for the market. Essentially, trading is boring. Once you know what you're doing, you're simply waiting half the time for the market to come to your key levels, and then you act on it. And then again, with the minimizing your losses, we don't want to take big risks. We don't want to blow ourselves up in one day, because then we can't trade. If we blow ourselves up in one day, we'll miss tomorrow's move or we'll miss next month's move. Like, we need to be able to take risk, but we don't want to allow ourselves to go underwater in one day or on one trade. And so along with those on how to win in trading, we need to stay consistent. We need to know how to properly manage risk. We need to know when to cut our losses early. We need to know to not to revenge trade. And most importantly, we need to know when to stop trading. We need to know when to go outside. We need to know when to go touch grass. So with those basics of what trading is, let's dive into the mindset of a trader. Every trader should know patience, and that is simply just waiting for your setup and acting when it gets there. The market rewards discipline, not constant action. So again, like I was saying earlier, trading is boring. We can't just buy and sell all day and expect to make money. We have to wait for confirmation. We need conviction in our ideas, and simply just waiting for the market to come to our areas and letting the market do its thing. We don't control the market. We can only react to it. Next is to have confidence. Trust your edge and your plan. That doubt that you create leads to hesitation, and then the hesitation leads to mistakes. Because when you start to hesitate and you don't go in with your original plan, now you're emotional. Now you're acting off of emotion. And let's say the market comes down to your level. You have your entry model. It gives you the signal, but you wait 10, 15 minutes and the market's already halfway up, or it's already halfway to your take profit. Now you have that fear of missing out, and there's no guarantee that your entry model was going to work to that full take profit, but now you're in the middle of the trade. And so for that trade idea to even become invalid, now you're risking way more than you should. And so you need to be confident, and win or loss, you have to trust your edge. Follow your plan, and if that trade works out, on to the next one. If it doesn't, on to the next one. Lastly, losing. This is one of the most important things that people need to understand is that losses are a part of the game, and the key is bouncing back with logic and not emotion. So you take a loss. That does not mean to hop into another trade and basically just keep swinging until you hit one green trade, because before you know it, you've taken 5 losses in a row and your account's gone. So basically what I mean is the losses are a part of the game. We don't want to just sit there and take unnecessary losses. We have good losses and bad losses, and those bad losses are where we're taking trades with no logic, and we take a loss and we enter another trade and that one loses. And then what do you think is going to happen to the next one that you enter if there's no logic behind it, if our setup isn't even there? More than likely, you're going to lose. Or if you do hit on it, you're reinforcing bad habits into your trading, and it does not lead to long-term profitability. And with all of these, you need to be disciplined. Like, you have to be disciplined to have patience. You need to be disciplined to actually be confident in yourself. And even when you do take losses, you have to be disciplined to not keep clicking buttons if there's nothing there. And so what I recommend is, after you lose, to go and journal your trade. Allow yourself to breathe and think on what you are doing on that day. You have to be focused when you're coming into this market. 95% of people fail at day trading. So it's definitely not easy, but if you can master these things and everything else I said above, it gets to be a lot easier, and you'll see the growth curve. Moving on to the tools that I use for trading, starting off with TradingView. This is just the app that I use to chart up my entries or my key levels. It is about $15 a month. Otherwise, you get delayed data, but it's real smooth, and they have a lot of indicators and tools that you can use to help your trading that you might not be able to get on other platforms. I also use interactive brokers. Most people nowadays, they use the prop firms, which is, instead of risking a lot of your own capital, it's a good entry way to get into the game. So if you guys are interested in any prop firms, I have some links in my description. And basically what the prop firms are, it's like little risk for big reward. We'll put it that way. Most accounts are like 50 to 150 bucks. And as long as you follow their set of rules, you can turn a profit. Lastly is what I use to journal, and that would be TradeZella. This is where I mark out all my trades, my emotions that I was feeling during that trading session or certain trade, what went wrong, what went good, and they have a good platform on what you're doing good on your trading. It takes your data and it inputs it in there, and it gives you some cool diagrams and charts. So now that we kind of went over all the tools, the mindset, and the basics of what trading actually is, let's dive into the strategy. So for my strategy, I mark out session highs or lows, whether that is London session, Asia session, and previous sessions. So previous highs or lows, previous daily highs or lows. So to find that London session, we go from midnight to 6. Asia session, we use 1800 to 0. And why we do this is because the Asia session is when all the Asia traders are waking up and they start trading the markets. Same thing with the London. So there's liquidity resting when those traders are entering and exiting the market. So mark out the session highs or lows. London being from midnight to 6. Asia session from 6 p.m. to midnight. And then we mark out our previous day's sessions. And then what we do from there is we wait for a sweep of session highs or lows. So we wait for the market to move into those areas, and then from there we go to the lower time frame. Whether that's M1, M2, M3, M5. I like to use the lower time frame just because it can help me manage my risk. And if I start to use the higher time frames, I have to risk less, but the higher time frame, it gives me more conviction in my trading. But these lower time frames, we have our higher time frame bias, and then we go down to our lower time frame and basically wait for our reaction. And then once we get our lower time frame confirmation, we wait for an IFVG after taking out liquidity. So we drop down to our lower time frames, we wait for our session sweep, then we drop down to our lower time frames, and then we wait for our IFVG setup. So what that might look like is, here's our Asia session, and then London session comes through, takes out that Asia session liquidity, and then we wait for an IFVG going in the opposing direction. Or for most people that are trading New York, a lot of times what happens is New York session will come through and we sweep out those London lows one more time, and then we get an IFVG setup. But if that doesn't happen and we end up getting, here's our Asia session and then here's our London session, a lot of times we'll come down, and then before New York starts, we'll come down and sweep out that Asia session low. So then what we're waiting for is a reaction here. Do we get our IFVG set up, or do we continue down lower? And so that's why it's important to wait for that lower time frame confirmation, because we don't want to catch a falling knife. In this scenario, if we take out sell side liquidity and the market doesn't want to move in the opposite direction, like we're not getting that reversal, more than likely we have the correct or the incorrect draw on liquidity. So the market could be moving down to a different point. But then ultimately we take our IFVG, or we take our entry on the IFVG confirmation, and we set our stop loss at the most recent swing high or low. And then we take profit at the opposing liquidity. So we swept out the lows, we get our IFVG, we enter here, we put our stop loss at the lows, and then we target buy side liquidity. Here's our next opposing liquidity. We would watch how the market reacts at these internal levels, just in case the market wants to sweep this area and then take a leg down. The market moves from liquidity, so it moves between the highs and lows, and simply just waiting for the market to react. And then we manage the trade as it moves in our direction. So here, if we entered this one, we would manage our trade as it comes up to this level, because sometimes we might come up to this level, sweep it, and then reverse. So that's why we want to manage it as we're approaching levels of liquidity. So now that I kind of gave you what I'm looking for exactly, let me show you exactly on the charts what I'm looking for. So we'll start off here. We come into the session, we mark out our Asia session highs, we mark out our Asia session lows, and I have the indicator on so it automatically just throws it up, but just to show, for example, we mark out our London session highs and our London session lows. And so this is about an hour before market open, but let's just watch what happens. So as price trades down, we've taken out previous session liquidity, and look at what price is doing. It's not getting accepted under this level. We're starting to reverse. We're getting our inverted fair value gaps. We're creating bullish fair value gaps, showing that price doesn't want to move any lower. And we can click the buy button here. We'll buy, set our stop loss at the low, and we can just target some session-based liquidity. And we will just react to what price does as we start taking out highs, as price moves up into areas, because ultimately, as price takes out points of liquidity, if we're right, we will go up to here. But if we're not right, we could come up to any one of these highs and reverse. And so we're in our trade, we get our retest, price starts trading up, there's market open. This is pre-market, so it's not the best idea, but you can still find them. And so we've taken out one set of buy side liquidity here. This is an area where you could look to trim. Okay, and now look, I wasn't able to stop it in time, but here, what did the market do? We were lacking displacement above the highs. We came down. So managing your trade above these highs would have worked. And then look at what the market did when it got up here. Lacked displacement at the highs. We came and took out all this buy side liquidity, but then what did the market do? It started reversing. And look at how the market reacted when it did take out that buy side liquidity. So whether you took profit or had your stop set to before entry as we started taking out liquidity levels, look at what we did up here. We took out buy side liquidity. We have an inverted fair value gap here. And from here, depending on how the market closes down here, do we start getting candle closes below? So this one would have hit. Just by reacting to what price was showing you that it didn't no longer wanted to go up, we lacked displacement at the highs. We start inverting bullish fair value gaps while creating bearish fair value gaps. And so if we entered this long and we didn't enter this short, or we got stopped out at entry because we didn't take the short, then what we would do is we would zoom out. Okay, where is the market likely drawing to? So after we zoom out and we can see that this session low over here looks to be the draw, as we've taken buy side liquidity, we're starting to invert bearish or bullish fair value gaps, and now we're starting to displace lows. Then what we can do is just wait for our next key level to tap. Okay, we've tapped this key level. We do have a 5-minute fair value gap here, and notice how price is lacking displacement at the lows. So if we drop down to M1, kind of already did it, but this would be your entry. You would enter here. You get to your lower time frame. We've taken out that previous session liquidity, get your inverted fair value gap. Again, what you would like to see is us start creating bullish fair value gaps. If price comes up here into some bearish order flow, this is where you can start to manage your risk, because we're coming into an area where the market might reject from. And then if it doesn't, and we start disrespecting all of this, then you can start to target up higher and managing your trade as we come up into highs or some sort of bearish footprint. So let's just see how this trade would have played out. Get our retest. And this is in a little bit of a later session, so this kind of calls for a little bit of choppiness as there's not a lot of volume in the market. But it ends up hitting that take profit, and then look at what happens. We come above that area, we start creating bullish fair value gaps, and like just because we took out this high does not mean we just take any inverted fair value gap. It can work like it did over here, but it's less probability. And so I don't recommend taking those ones. You'll find a lot more success when you're waiting for previous session highs or lows to get tagged. So let's move on to the next day to see what happened. So when coming into the market, we mark out our Asia session highs. We have our London session highs, Asia session lows, and our London session lows. And so again, for you London traders, if we just look at what price was doing up above here, I mean, here's our Asia session, here's our London session, and we have taken out session-based liquidity. We've taken out Asia session, and look at what we're doing. Here's our entry. We have our 5-minute fair value gap. It then gets inverted, and we start moving into that London session. So as soon as you get this inversion right here, you can place your stops at the swing high and start targeting opposing liquidity, which would be Asia session lows, or depending on how we react down here, you could target previous day's low. So let's just see how we react to see what ends up happening. So we end up displacing those lows. We've now taken out Asia session lows. We've created a 1-minute fair value gap through it. Do we invert it? Notice how here we did not get a candle close. We did not invert this fair value gap. We would have needed price to trade up and close a candle above this area for us to have conviction to go long. Instead, if you entered this idea, you could see where the market is likely drawing to. We're creating bearish fair value gaps. We are displacing through lows and moving towards the next area of liquidity. So the market took out that previous session's low. Now what happens? We can drop down to our lower time frame. We do have an IFVG here, but since there's so many stacked up on top of each other, you could also just wait for this 3-minute, and this will give you a little bit more conviction on if that trade is going to play out. But that 1-minute will give you a lot better risk to reward, as you would already be in right here. Essentially, for this trade idea, you're saving yourself about 20 points. Yeah, so if you wait for the 3-minute, you're risking 40 points. If you take this first M1, but it doesn't give you the best conviction, you're risking 20 points. So let's wait for the 3-minute. All right, here would be our entry. We can just click buy, stop loss at the lows, and start targeting buy side liquidity. And again, look at what price is doing after it takes out session lows. We are inverting bearish fair value gaps, and we are creating bullish ones, signaling that price doesn't want to continue down just yet. But as the trade starts to move in our favor, we need to start to manage it. There's market open, and that would have cashed. And then again, you don't have to just put your take profit up here at this session high. We have these London highs right up here. And then really just reacting to what the market is showing you when it comes up to these highs or lows. We're creating bullish fair value gaps. So that again, as you start coming up into profit, then you can start to trail your stop loss at areas on where you can secure profit. Like if this fair value gap were to invert after taking out some session highs, I would just close the trade. But let's see what happens. We respect the fair value gap and we continue pushing up all the way to the next session highs. How do we react at those London session highs? It looks like we're displacing them. We're creating bullish fair value gaps. So if we start displacing these areas and we're not inverting fair value gaps and we're respecting them, where's the next draw on liquidity? We have these previous session highs over here, and then there's those London highs over here. And so using that to help kind of justify if that trade is going to run, like look at that. If we would have inverted these fair value gaps, then the whole narrative would change. We would then be thinking, okay, we need a retracement before we can go up higher. And we go straight to that previous session high. So again, even though this first one failed once we took out those Asia session lows, but the key was that would have saved you is that we didn't invert that higher time frame fair value gap. But then once we started displacing lows, we creating bearish fair value gaps, respecting them, we see the correct draw on liquidity over here. We notice a lack of displacement. We notice an inverted fair value gap happening. We notice bullish fair value gaps getting created from that low. Then I get extra confident. So that one would have worked out. Let's move on to the next day. So as far as entry for this next day, look at what we did. We came under these London session lows. There's nice lows right here. And what did the market do? This is all pre-market, and then this was news. So I wouldn't really advise taking the setup before news, but just to show, for example, and like if it were to play out in your favor, yes, we are on M5, but let's drop down to a lower time frame. So here we're under that London session low. These IFVGs didn't work. And like, that's really why I recommend not trading it during off session hours. And then again, I mean, kind of like what I was saying before, if we take out the London session highs, and if we were to invert this fair value gap, then the whole narrative would change. But that's not what happened. Instead, we came into this fair value gap, and then we started creating bullish fair value gaps out of it. So in terms of the model for this session, there really wasn't a clean entry to where you could have entered unless you were in down here. And then realizing what news came through. So for that day, it didn't work. But no trade, no losses happened. There's nothing wrong. I mean, there's no reason to be upset, even though the market did expand like this. As long as you didn't take a loss, there's no reason to be upset. So let's go through one more day just to see if we can get some cleaner price action for the model. So moving into the next day, we have our Asia session lows. We have our Asia session highs. We have our London session highs. And then we have our London session lows. Okay, look at what happened. Market opened up. We swept out those Asia and London session lows. No clean fair value gaps. Actually, wrong time frame. Here we swept out the lows. Price is still in the same spot, so we won't have to do nothing. But click that buy button, put our stop loss at the lows, and start targeting either session highs, or if we look left, we have our Asia session highs over here, and basically just targeting opposing liquidity and waiting for the market to react. So right now we have our stop loss at the most recent swing low, and we have our take profit at Asia session high. And then now we wait, look at what the market did here at this high. This is where you start to manage your risk. You could put your stops to entry. If we would have gotten in on the first inversion, our entry would have been right here. But do we invert these fair value gaps? So boom, we swept these highs, inverted these fair value gaps. And so that was kind of your signal to start to manage your risk. We lacked displacement at the highs. We did take out a set of buy side liquidity, but it didn't work. And so from there, you would either take profit or put your stop loss to break even. But then on the flip side, we took out buy side liquidity, we inverted fair value gaps, and then started moving towards sell side liquidity, gave a retest and swept out lows. And so again, that initial idea didn't work out, but just by being able to watch price and identify what it's doing, this could help you avoid a loss, or this could help you secure your profit on the day. And then you could even flip the narrative. You could say, oh, we're lacking displacement at this point of liquidity. The draw on liquidity could be lower. And then if we look left, once the market did that, what's over here? Previous day's low. So we have our previous session low. Okay, it's not exact, but we ended up touching it. And then look at what happened. The market ends up sweeping out that previous daily's low. We have our inversion here. So you could enter here, stops at the lows, and then start targeting out some highs. As price comes up into these points of liquidity, you need to start asking yourself, what is the market going to do? So we took that high. You could begin to manage your risk. You could go BE, you could trim some, but then look, market gives a retest, starts trading up, and ends up hitting at least this high. And so watch how the market reacts at each set of highs. Oh, well, but again, I mean, same idea. We came up to these highs and look at what the market did. So just watching what price does as it gets to points of liquidity, there's definitely enough room to secure some gains. As much as we would like to hold our profit all the way to session highs, in reality, it doesn't always work out like that. So by using that and identifying points of liquidity, which are highs and lows, we can react to what price is doing, or we can begin to manage our risk as it starts to move in our favor to protect ourselves just in case something like this were to happen. And so then again, we end up sweeping out the lows, creating bearish fair value gaps through the area. Yes, we did invert this one, but what did price just do right here in the middle of the session? It just fell 200 points in the middle of the session. And if we notice when we took out the lows again, notice how we aren't creating any bullish fair value gaps. We aren't creating displacement to the upside in our direction. So I wouldn't be favorable in that one just because of what price has been showing me. That's where it can be very important to watch and just identify what price is showing you and just react to it. Rather than, as much as everybody would like to shoot for the stars and get a 10-hour trade, it's not every day that the market gives you that opportunity. But if you react to what price is doing and showing you, it will definitely increase your chances of catching a trade like that. So I hope all of that helps you guys. Again, we mark out our session highs and lows. We wait for one of them to sweep, and then we watch price. We wait for our inverted fair value gap, and then we target opposing sides of liquidity. Whether it's session based, whether it's internal highs or lows, previous daily highs or lows, and react as we come up into the areas. The biggest key is reacting. We don't want to let a green trade go red, so managing our risk as we get up into those areas is important. So now that I showed you guys kind of what I look for when I'm looking for trades, these are some actionable steps that you guys can take. And that is master one strategy. Get really good at identifying one strategy, and I promise you, you will see growth in your trading. All you need is one strategy to be profitable. I can't tell you how many traders I know that only trade one strategy and they make money from the markets month after month. Just because it doesn't work one day does not mean that that strategy doesn't work. Do some due diligence. Go back test it. Go watch how price reacts. Get really good at that one strategy and master it. Next, journal daily. If you can just journal daily, and like, this is going to help you identify where you're fucking up, where you're going wrong, like what you're doing good. You need to journal daily so that way you can analyze what you're doing and improve from it, whether it's good or bad. And obviously we want to keep doing what we're doing good and getting rid of whatever we're doing bad. Like, this is one of the most important things that a lot of new traders don't do, and that is to journal daily. They think that, oh, why do I need to journal? And their P&L will represent why they need to journal. Next is that build that discipline and consistency. Do the same thing over and over and over again. Do all of this together. You need to do it consistently. Like, you need to do it every day. You have to do it until it becomes a habit. It becomes normal. And then once you start doing all of these things, you will see the growth in your trading. Like, whether it's building that discipline for patience and just waiting for your setup to appear and knowing when to click buttons and knowing when not to click buttons. And then eventually you'll just fall in love with it because you'll see the growth in your trading. Like, once you start to actually make money trading and you start hitting good trades, you fall in love with just the whole process in general. So work on building that discipline and be consistent with it. Otherwise, if you're not, it's just not going to work out, and eventually you're going to blow up accounts and you're going to lose money. So I recommend building up that discipline and working on that consistency. If you guys took anything from this video, feel free to drop a like, drop a sub, and I'll catch you guys next time. Thank you.